5, that is the Indian Accounting Standard uh, 115. Okay, so in last sessions, okay, so this is the last part of the chapter third. After that, the third chapter that we going to conclude today. So, in this chapter, we understand the different accounting standard. That is how the financial information should be presented as per the requirement, as per the uh, regulations or the standard that we can say we seen in the schedule 2 of the Indian Amendment Companies Act 2015. Okay, so in this chapter, we understand the AS1, that is the Indian Accounting Standard 1, that is the presentation of the financial statement. So, what is the base line for the presentation of the financial data or the financial information? So, what are the different guidelines? We understand all these guidelines in these sessions. Uh, in the previous sessions, we also understand the Indian Accounting Standard 7, that is the statement of cash flow. Okay, that part we also see that how we presented the different cash flow into the three different categories. Okay, we also see in the last sessions we understand the AS8, that is the accounting policies, changes in accounting estimates and errors. Okay, whenever the company wants to change their financial statements, okay, if in that cases if sometimes they miss the information, if sometimes they misplace the information, if they wrongly estimates any we can say if there is a mathematical errors. Okay, in some of the cases, like if sometimes the company makes the errors, so in such a cases that company can we can say estimate that errors, correct that all the errors. So for that purpose, the Indian Accounting Standard 8 uh, provides the we can say guidelines to the companies how to formulate or how to correct that errors, and we can say the how to is change the changes in the estimates and the changes in the accounting policies. Okay, so in also in Indian Accounting Standard 34, we understand the interim financial system. That is how the companies do the interim financial reporting. So whenever in between the financial year, the company wants to disclose the financial information for the reference of the different stakeholders, then company do the interim financial reporting. Okay, so what are the different guidelines for this interim financial reporting, and why interim financial reporting is beneficial to the organizations? That we also see in the last sessions. Okay, and we know that the company is publishing the data quarterly. Okay, so that means uh, in the financial year that the different stakeholders got to know the financial position of the information, and they get updates 4 times. Okay, so this is how the interim financial reporting helps this stakeholder that increase the decision making capacity of the investors. That interim financial reporting builds the confidence among the investors and the stakeholders. Okay, because from the interim financial reporting, the different stakeholders got to know that what is the current financial position of the organizations. Okay, what is their liquidity position, what is the current cash position, what is the solvency position of the organizations, if the organization takes any big make any big changes in the policy. Okay, so all these things must be known to the investors, those who are having the big investments in that corporate houses. They must know what are the changes in the policy. So, to we can say to provide that information to the different stakeholders, the companies provide the interim financial reporting. Okay, so we understand from the interim financial reporting that company has to publish these four statements. Okay, in between the years, that is the balance sheet, income statements, or we can say the profit and loss statement, or we can say the statement of the cash flows, and these statements of the changes in equity. Okay, and what are the we can say what are the different challenges we understand from the AS34 while the preparation of the AS34? So because we know that we tax calculate at the end of the financial years. Okay, so while estimating the tax in between the years, so that part is very complex. So it's the major challenge in the preparation of the interim financial reporting. Okay, so that part we understand up to date. It is the last topic of the chapter third, that is the Indian Accounting Standard 117, and that Indian Accounting Standard is about the revenue from the contracts with the customers. Okay, so when we know that every company, every organizations, every business firms is doing a business. The main motive is to generate the revenue. Okay, that means whatever the company is producing. Okay, it may be a goods producing company or the organization, or we can say it is the service companies providing a services. So whatever they are doing the business, the main motive behind the business is to generate the revenue or to generate the profit. So that means the revenue is very important from the company's point of view, because for that main purpose company is doing a business in the market. That means they are building that we can say the big plants. Okay, big buildings. So all these things they are making the complex systems, complex uh, we can say methodologies. So all these things they are doing for why? Because to generate the revenue from the business activity. Okay, so that means the revenue is the one and foremost, we can say, objective of the any company. So no company is doing the business in the market for the social service. That means you not get the goods and services free of cost. That means whenever the customer wants the goods and services, they has to pay some cost, and that cost is the revenue for that the company or the organization. That means revenue is one of the most important aspects from the company's point of view. So what are the different guidelines? How the revenue should be recognized by the companies or the organizations, and how they put that revenues or the values into the different financial statements. That is in we can say in profit and loss account, how they put the revenues, we can say in cash flow statements, how they we can say put the transactions of the different revenue inflows, how they put the values in the statements of the changes in equity or in a balance sheet. So, for the revenue recognition, that is, we can say the revenue from the contracts with the customers. Okay, whatever they are generating the revenue for this purpose, the AS 115 provides the guideline. Okay, so the AS 115, that is the 115, actually implemented in India from the 1st April 2018. So before that, there are two AS, that is AS11 and AS18, that provide the guidelines on the revenue recognition. But we can say to unified all these things, the government came up with the we can say one one standard, that is the we can say the AS 115. Okay, so to we can say to align with the global standard, the government, that is the India government wants to changes in the reporting of the revenue. Okay, so they want to compare the Indian organization, Indian corporate houses with the other we can say the foreign organizations or the companies on the international level. So, okay, so for this purpose, when we can compare the financial information on financial data, when we are when we prepared the with the same format the financial statement as per the global standard or requirements. Okay, then and then only we can compare the financial information for the two different countries. Okay, so for to make the we can say the financial statements of Indian companies, Indian corporate houses, okay, as per the global standard. So that's why this AS 15 provides the guidelines for that. So replaces the AS 11 and AS 18 since March 2018. Okay, so in March the process of this AS 115 is complete, and from the 1st April 2018 the implementation of AS 115 starts. That means onwards all the companies we can say recognize their revenue or put their values in the financial statements as per the AS 115. Okay, so that Indian AS5 actually we can say align with the IFRS 15 globally. So the IFRS is the standard used on international level, that is International Financial Reporting Standard 15. Okay, so that standard provides the guideline on international level to we can say to put the entries of revenue into the different financial statements. Okay, so in AS 115 we align with the global standard. Okay, so that is the main part, and we combine the two different AS, that is the AS 11 and AS 18, and club them and make the one uniform AS for the revenue recognitions. So that is the one of the we can say advantage of AS115 now while putting the revenue into the financial statements. Okay, companies not need to refer the two standards, that is the AS11 and AS18. So now company needs to refer only the one AS, and that is AS 115. So it's now the single model. So the provides the one comprehensive framework for revenue recognitions across all the industries. So the we can say for the different companies, for the different sectors, the company may be a goods producer or the service provider, or we can say the combination of both, or because for the different sectors like the healthcare sector, IT sector, finance sector, agricultural companies. So for all the sector, we can say the FMGC, the standard now for the revenue recognitions or the revenue entries are same throughout all the sectors and for all the companies in AS 115. So we can say now we understand. So what are the core principles of the AS 1115? So first one is the transfer recognitions. So when we can say the revenue is recognized to depict the transfer of promised goods or services to customer. Okay, so when any organizations or company generates the revenue, when when the company we can say sells the goods or services which they are producing in their plant or in their process. So in AS115, actually the revenue we can say on two things. They no, we can say uh, provides the guidelines, that is the transfer of promised goods or services. Okay, for example, uh, mm, we go to any shops and we purchase the pen. That means first when I ask for a pen to any shopkeeper, okay, so he will gives us a pen, that is the transfer of a promised goods or a service to the customers. And after that we can say the expected consideration is the amount of entity expect to receive in exchange for that goods and services. So in exchange of the pen, the customer has to provide the what is the value of that pen. It might could be a 5 rupees or the 10 rupees. Okay, so the customers need to pay some amount, that is the cost of the pen, to the shopkeeper. So this is how we can say the transfer of goods and services actually happened in the open market. Okay, so the AS11 5 provides the guidelines for the same. That is how companies sells their goods and their services, how they we can say delivered their goods and services to the customer, or how they transfer the ownership of the goods and services to their customers. Okay, and how they receive the revenue for that purpose. Okay, so this principle provides the guideline on this. So this principle ensures the revenue recognition reflects the economic reality of the customer transactions rather than merely contractual arrangement. Okay. So whenever we buy something, it is actually a contract between the shopkeeper and the customers. So it's same like way whenever a company sells something, any goods or any service, that means it's a type of contract that is the delivery of goods and services and transfer of the payments. Okay. So next one is the what is the scope and exclusion in the, we can say, the AS 115. Sometimes the company receives the funds, but we cannot consider it as a revenue. So what we exclude, that here we understand, and that all other parts we considered into the AS 115. So the Indian standard 115 applies to all the contracts with the customer with the specific exclusions. So, okay, so all type of contracts which made by the companies with their different customers. Okay, but some of the specific exclusions. So lease contract. Okay, so the lease contract is, we can say, the real estate property leased by the companies on the for the 99 years. So we know that we whenever we can say get the ownership of any land for the longer period of time, that is for the 90 years, 99 years, 100 years. So that is actually a lease contract. So this lease contract exclude from the AAS 1115. Okay, if the company is having the any property and they give that property on a lease, okay, the amount they received, they not included in the financial statement as per Indian standard 115. But actually, for this lease contracts covered under the AS 116 separate framework for the lease accounting. Okay, so we exclude the lease contract. And second one is the insurance contract. If the companies takes the insurance of the any of their machineries, plants. Okay, so they for the insurance contract, there is a separate Indian accounting standard, that is the AS 104, that is specialized in the insurance accounting standard. Next one is the financial instrument. Okay, we can say the company we can say invest in the stock of the other if in the stock of the other companies, that is they diversify their portfolio. Then this financial what they earn from that financial instruments, they are not put as per the AS 115. But the financial for this financial instrument, there is, we can say, the um, other accounting standard, that is the financial instrument handled by the Indian accounting standard 109, 1010, and 1011. Okay, so these are the accounting standard, that is the AS 109, 1011, and 1010 and 1011 are the comprehensive financial instrument framework. Next one is the non-monetary exchange. Okay, sometimes the companies are doing the non-monetary exchange. Non-monetary exchange means in that type of exchange, the we can say monetary value is absent. That is the exchange of the monetary value. That is the exchange of money, exchange of fund, exchange of currency is not involved. That type of exchange we called it as the non-monetary exchange between the entities. Sometimes we can say the companies we can say provides the goods in exchange of the other goods, so that's entries we not considered as the revenue recognition. So we not to do that entries in as per the AS 115. So these are the things we exclude from the Indian accounting standard 115. So yeah, as per the Indian accounting standard 115, to recognize the revenue, um, uh, in the company, there how they recognize the revenue, these are the 5 steps. This is called, as we called it, as the 5-step model. Okay, so it is a systematic approach to revenue recognition that transform the complexity into the clarity. Okay, so first step, first we understand the what are these five steps. So these are the five steps of the AS115 for the revenue recognitions. So first step is to identify the contract, establish the agreement with enforceable rights and obligations. Okay, we know that to minimize the risks, now the companies are doing the different types of contracts with the other party, with their customers. Okay, we know that if the quick transactions, the quick transactions we seen for the goods and services, that we called as the spot contract or the spot transactions. So likewise the forward contracts, futures contract, options contract, swaps contract. Okay, so according to this, these companies nowadays doing the business. Okay, in contract, the some of the specifications written clearly. That is the we can say the number of goods and services that to be delivered, or the quality of the product, price of a product, place of the delivery. We can say the time of the delivery, time of payment. So all these things is we can say clearly defined in the contract. So before recognizing the revenue, first as per the AS 115 um, tells that first we need to identify the contract. So what are the different specifications of the contract, and then we can say identify the performance obligations. Okay, now then we need to identify, determine the different goods and services promised to customers. Okay, so what is the quality of the product? Okay, what are the different goods and services which customer wants? Okay, so that we identify in the step number 2, and then determine the transaction price. Okay, so in third steps, what mutually the price decided by the company and the customer, so that we identify in this step number 3, that is we calculate, actually calculate the amount of the expected to be received. So for the goods and services which companies are going to deliver to the customers, or what customer demands. Okay, so for that goods and services, in third step calculate the price for that product. Okay, so that means that much amount the companies expected in return in exchange of the different goods and services. Now, next one is the allocate the transaction price. So distributed price among the identified for performance application. That means we then gives the different price to the different products. And next one is the recognize the revenue. Now, what they mutually decides in the contract in between the company and in between the customers. Now that price the customer has to pay to that organizations or to that company, that is the fifth stage, that is the revenue recognitions. So record revenue when performance obligations are satisfied. Okay, if the customers are satisfied with the delivery of the goods and services, the quality of the product, the number of goods he wants, or the type of service he wants. Okay, when he satisfied with all these things, then he provides the, we can say, revenue, or he pays the make the payments. So that payment is nothing but the revenue for the organizations. So this is how company recognize a revenue. Okay, so in step number 1, that is identify the contract. So what are the essential elements of the contract? Okay, so that's we are going to understand. That is, we know that for the contract purpose, we always want the two parties. So here one party is a company, and second party is the customers. Okay, so uh, contract always between the two or more parties. So in our case, one party is company and second party is the customer. So party commitment. Okay, so for these both parties, that is the company is the one party and second is the customers. So the approval and commitment from all the parties involved. So in the contract, the commitment should be there. That means they must follow whatever written in the contract, that is we can say obliged on both the parties, that is on company and that is on a customer. Second one is the clear rights. Okay, so whatever written in the contract should be clearly mentions. or we can say they identify the rights and payment terms clearly defined. Okay, so what are the rights of the company, and what are the different rights of the customers getting into the contract? That is the, we can see the payment terms. Okay, what is the date of payment? What is the price of a product? So all these things should be clearly mentioned into the contract. Second one is, which you can say, the commercial substance. That is, the transaction has a genuine business purpose and the economic impact. Okay, whatever the company received the payment from the customer, that payment should be a genuine payment. That means the goods and services, after the delivery of the goods and services, the genuine payment that must be received by the company. Next one is, we can say, the probable collection, the reasonable expectation of receiving promise consideration. So what are the other expectation of these two party, that is the company and customers, that should be clearly mentioned into the contract. Now next step is, we can say, identify the performance obligations. Okay, so what are what performance customer wants from the company, and what performance the company wants from from the customer. So all these performance expectations from both the sides are mentioned clearly into the contract, so that these are the performance obligations. So performance obligations are the distinct goods and services promised in contracts. They combined when they form the single performance obligations. Okay, so we can say, uh, from uh, from, we can see, the, if the company, uh, we know that in some cases that some of the individual businessmen, they also, we can say, receive their payments. Okay, so in the AS 115, they provides the guidelines for all the companies, all the, we can say, the individual businessman. Okay, so if there are the individual services, like the design, plumbing, carpentry are the separate components, or the combined obligation, that is the house construction contract combining all the services as one integrated area. Okay, so whenever if we already have a house, and we if there is some problems in the, we can see, in the plumbings, or in the, if you want to design, so for that one purpose only we make the payments. Okay, but whenever we want to buy the new houses, so in that case, we can, to builders, we can make the payment at once for the different services. Okay, for the, we can say, we can pay him for the house itself, for the, we can say, interior designing, for the plumbing. Okay, so these are, we can say, these are the combined services which are provided by the companies. Okay, so this is how, so we identify the performance obligation. So whatever the customers wants from the company, okay, what a performance customer wants, so this we identify in the step number 2. The key test is whether the goods or services are distinct or separately identifiable or integral, delivering a combined output. Is the customers want the combined services, or the customer wants the individual services? Okay, so that is how we identify in the, we can say, in the performance obligations. Okay, whenever you buy the ticket of the cinema hall, you have, whenever you, if you book your ticket online, then there, whenever you purchasing the tickets, okay, so you can set your book, and also you can purchase the some of the other items, as a popcorn, coffee, samosas, and all these things. Okay, so this is, we can say, your ticket of the cinema is the individual service, and the other things you are purchasing, that is popcorn, samosas, we can say, cold drinks. So these are the combined services. So in this step number 2, so whatever contract in between the service, in the company, or in between the customers, so this is how in second step we identify the performance obligations. Uh, in step number third, we determine the transaction price, actually the components of the transaction price. Okay, so what are the different components of the transaction price. First one is the fixed price, and second one is the variable components. Okay, as I told you the example that if you took the ticket of the any cinema hall, okay, so the price of the ticket is fixed. Okay, yeah, it is not the variable price. Okay, so it may be a 250 rupees if you consider. So it is the fixed amount or the base consideration specified in the contract. Okay, so whenever you buy the ticket online, so it is the type of the contract between you and the cinema hall. So it is the base price, it is the fixed amount you have to pay to book your ticket. But the other services like these are not the we can say the compulsory things. You can buy whatever you want. Okay, so these are the variable components. Okay, so your price ticket may goes to the 520 rupees if you buy more cold drinks, coffees, samosas, so all these things. So this is how in step number three the transaction price determined. In we can say in step number four, we allocate the price transactions. Okay, so whatever the services which we can say by the customers, the price should be separately mentioned for each and every service that allocate the transaction price. So the allocation is based upon the we can say the standalone selling price of each performance obligations. This ensures fair distribution reflecting the digital while delivered. Okay, so whenever you get the ticket so here is one another example is given, that is the so the flight ticket is shown in on the left. Okay, so whenever you buy uh, the ticket of the flight, so there are some different we can say the different components of the tickets. That is the we can say the base fare of your traveling. That is the base price of your traveling. That is the flight services. Okay, that is the core transportation cost. That is the first class. That is the base class. Base cost we can say. Next one is the meal services. Okay, so in some of the flight, there are these are the services which are compulsory. That means you have to take that services from the we can say in the flight itself. So the meal services you pay some amount, and the baggage handling. Okay, so for your luggage you pay something, but the ticket in the ticket. The we can say the flight company should mention all the things separately. Okay, how they collect the payments from the customers, so how they get the revenue by providing the different services, that is from the core transportation, from the mail services, and from the baggage handling. So all these services are different. Okay, that is the we can say the transportation is the different service. Okay, so mail service, mail delivery is a different service, but you get at the one point, that is in the flight. Okay, and we can say the provider of the service is also same. That is the we can say the company, whichever it may be. We can say the whichever the company. Okay, so that should mention clearly into the all these things should be properly and the separately mentioned in the ticket or in the invoice of that company. Now last one is the recognized revenue. Okay, so whenever you get the bill, whenever I bought the ticket for it may be for the cinema, or it may be for the aeroplane, and then the things are clearly mentioned that for these things I have to pay this much, for the another service I am has to pay this much. Okay, so all this, so the total is the financial obligations the customer has to pay to that company. Now then what customer do? Customer pay the amount of money to the company, and so this is how company recognize the revenue, how they get the revenue. So the revenue recognition when control transfer to the customer side. Okay, so while getting the revenue, the company gets the revenue between the two different methods. That's it. That is the overtime. Okay, at the same time of the delivery of the goods and services, if the company gets the their revenue, that is the we can say overtime. That is the customer simultaneously receives and consumes the benefits as the entity performs. Okay, so point in time, we control the transfer at a specific moment when the performance obligation is satisfied. Okay, we can say at the same point of time the delivery and the payments are settled, or it may be cases that the delivery of the goods and services and the payments settle on the different times. So with that 5 steps, the AS115 provides the we can say guidelines for the revenue recognitions. So we can say in some of the cases here, the one case is given, that is the principal versus the agent considerations. In some of the cases that the company gets their principal amount, that is the control goods and services before transfers, and in some of the cases they provide their services through their agents. Okay, so arrange for the others to provide the goods and services. Okay, so whatever they get directly from the customers, that is we can say the recognized gross revenue. Okay, and whatever they gets from the agent as well, then they recognize the net revenue. Okay, so this is how we can say recognize the revenue in the company. So what are the contract modifications and combinations? Okay, so contract combinations, contracts at we can say at near same time with the same customers may be combined for the accounting purposes. So we know that AS115 we formulated by combining the two different Indian standard, Indian accounting standard, that is Indian accounting standard 11 and Indian accounting standard 18. Okay, so the separate contract treatment, the modification treated as a separate contract if the scope and price increases for the distinct goods and services. Okay, whenever we can say for the goods and services custom companies producing, if the scope and the prices changes, then for the customers, then we consider as the separate contract. And the existing contract adjustment, the other modification exists existing contract accounting perspectively. Okay, so we also can the companies can make the modifications in their existing contract with the customers. Okay, so we can say the next part is the disclosures and judgment. So company we can say must provide the comprehensive disclosure to enhance their transparency and investors understanding. So how the we can say the disclosure of the revenue is very important from the point of view of the different stakeholders. So how much revenues company generating? Okay, so that value provides the guidelines to the different stakeholders. That is next one is the first one is the performance obligation. That is the nature, timing, and the key terms of the promised goods and services. Payment terms, the significant payment terms, including the timing and conditions. Okay, so these are the transparency in the revenue recognition that provides the we can say the clear understanding to the different stakeholders. So, what are the recent amendments and difference, uh, and how the Indian accounting standard AS 115 is different from the IFRS 15? Okay, so there are some of the little that we made the AS 115 in accordance with the IFRS 15. But what are some little differences? So variable consideration that Indian accounting standard 115 exclude the penalties from the variable consideration example, and the excise duty presentation that requires the separate presentation of excise duty in profit and loss statements. Okay, so in we can say in IFRS 115, uh, that we can say they enter the excise duty in the same statement of the profit and loss account. But as per the Indian accounting standard 115, we require the separate presentations or the separate entry of the excise duty in the profit and loss statement. and the Indian AS 115 exclude the penalties. So the practical challenges and the regulatory insights while implementing the AS 115. So what are those challenges? That is their returns and refunds. So we know that whenever the company gets the revenue for the services and the goods they are providing. But if this sometimes what happened, the goods returned by the customers. Okay, because of some we can say because of some defaults in the goods. Okay, so if there is some other uh, difficulties in the goods. Okay, so at that time, what customers do, they return the goods. So at that time of what time, the company has to refund the payments to the customers. So this is the main challenge, how to access that entry. That is handling the complex refund policies and refund obligations requires careful estimation of the expected returns and their impact on the revenue recognition timings. We know that the we can say the timing of the revenue and the timing of the refund is we can say we cannot say it is the we can it's, we cannot say it is the standard at time. So the timing is depend upon the return of the goods by the customers. So that handling of these complex things, that is the return, how then how much we return to that customers on what time. Okay, so already we made the revenue entry in the financial statements. Now we need to minus that return funds into from the revenue. So how so this is the main challenge in the we can say AS 115 while making the entries of the revenue. Next one is the consistent application, that is the ensuring uniform approach across the similar contract and contract portfolios while maintaining the appropriate judgment of the unique circumstances. So the uniform approach across the similar contracts, so it is difficult to do the we can say the similar adjustment. Next one is the regulatory guidance, that is the we can say the NFRA and FRC thematic review highlight the common implementation pitfalls and share industry best practices for the compliance. So these are some real world examples are given to us. Okay, so here the right in the left side, if you see the image, that is the revenue recognitions in 2077, that is the quarter third. Okay, so how the any construction company recognize their revenue. So that is the example, that is the case study. That is this one of the construction companies building mm, uh, we can say some residential real estate property. Okay, so how they recognize the revenue in the third quarter of the 2077. Okay, so first that is the overtime. So what are the different revenue recognitions? We can say methodologies how they recognize the revenue. That is the overtime recognition. So revenue recognized progressively as the building construction advances, reflecting continuous transfer of control. Okay, we know that when the building construction start, at the same time the near about the 90% of the flats were sold by the any of the construction company. Okay, so how they get the revenue, that is the main important questions in the everyone minds. So the next point is the progress measurement. So input method cost incurred or the output method milestone achieved to measure the uh, completion percentage. Okay. uh, So, when the company actually sold the flats and when they gets the payment, so this is how we the company recognize the revenue. So this is some summary of the why Indian accounting standard 115 matters. That is the first point, we can say the clarity and the consistency. that Indian Accounting Standard 115 provides the clear framework for the revenue recognitions that clearly eliminating the ambiguity in revenue recognition across the diverse business models. So, Indian Accounting Standard 115 provides the uniform guidelines for all the sectors, for all the companies, for all the organizations. Or the Indian AS 115 enhance the comparability. That is, we can say we made the Indian AS 115 on the grounds of the IFRS 15, that is the International Financial Reporting Standard 15. So that's why the comparability of the Indian companies with the we can say the foreign companies on the international level, so that compatibility increases because of the AS 115. Next one is the improved decision making. This uh, that delivers the more useful financial informations of the revenue for the different stakeholders. That is for the investors, for the creditors, and the other stakeholders. So this information provides the decision making ability of the different stakeholders. Now, fourth one is the professional judgment. Okay, so that require thoughtful analysis and comprehensive disclosure, evaluating the accounting professionalism. So, by analyzing all the accounting policies, this AS provides the professional guidelines as per the standard. So, we can see this is the professional judgment. Okay, so the road ahead implementing the AS 115 with confidence. So, what is the implementing? We can say the strategy while providing the guidelines to the we can say as per the AS 115, that is the framework mindset. So embrace the five-step model as the strategic framework, not merely the compliance checklist. But actually, the five-step model developed as per the AS 115 to recognize the revenue in the organizations clearly. Next one is the investment in excellence, invest in comprehensive training and robust the system to accurate contract analysis and implementations. Okay. So what is the contract between the company and the customers? Okay, so that accurate analysis for this, the training of the accountants or the financial expert in the company is much needed. So the investment in excellence. Next one is the continuous learning, stay current with the regulatory guidance amendment and improving the best practices in the industry. Okay, so and last one is the trust through transparency. That is the AS 115 delivers the transparent, reliable revenue reporting that reveals the investors and the stakeholders' confidence and increases the business value of the uh, company. Okay, so these are the guidelines provided in the AS 115. So I will show you the exact uh, tab or what is written in the AS 115. So will you guys understand? So in PPT, actually, I'll tell you the brief what is given in the Indian Accounting Standard 115. So this is what exactly what is written in the Indian Accounting Standard 115. That is the revenue from the contracts with the customers. So this is all we can say. If you see and show, so this is nearly about the 8 to 10 pages documents. Okay, so in that 8 to 10 page document, so all the things clearly mentioned about the revenue recognitions. Okay, so it is nearly near about the 10 or 11 pages document. Okay, so I'll share the link with you. So you please read it whenever you get time. So first we read the objective of the AS 115. What is the main objective of the Indian Accounting Standard 115? The objective of the standard is to establish the principle that entity means the company shall apply to report the useful information to users of the financial statements about the nature amount, timing, and uncertainty of revenue and cash flows arising from the contract with the customers. Okay, that means that AS115 provide the guidelines of on the nature, amount, and the timing and the uncertainties of the revenues associated with the revenues. Okay, so this is the main objectives of the AS115. And to meet the objective in paragraph 1, the core principle of this standard is that the entity shall recognize revenue to depict the transfer of promise of goods and services to customer in an amount to reflect the consideration to which the entity expect to entitle in exchange for those goods and services. That means in contract, whatever they decided, whatever they mutually decides that the for which goods and services, that is the promise, that is the transfer of promised goods or services to customers. Okay, if the customer gets that goods and services, then customer are liable to pay the price for that product. Okay, so these are the guidelines provided in the AS115. So here you see identifying the contract is the first step that we see in the different step of the revenue recognitions. Okay. So next step is the performance obligation. So here the guidelines provided on the performance obligations, that is if you read that something that is at contract inception, an entity shall assess the goods or services promised in contract with the customers and shall identify as a performance obligations. That means the this is the obligations to the company to perform like this. That is, they have to provide the that quality and quantity of goods and services to the customers. Okay, so the goods or services that is distinct, so all the things should be clearly mentioned in the AS115. Okay, so these are the guidelines. So all the see guys, so these are the guidelines on the non-cash considerations. If you read the allocation based upon the standalone selling price, allocation of discount. Okay, so all these things are clearly mentioned here in the AS 115. Okay, so I'll share the link with you in the chat box. So whenever you have time, please read that document thoroughly. Okay, so then you understand. Just a second. Okay, so here we finished the chapter number third. Okay, so anyone have any query till now? You can ask. Okay, so I share with you the link of this AS115. So please copy the link and save with you. So we can you can read the AS115 whenever you guys have time. Okay, if anyone have any questions, you can ask, or otherwise we some sessions. Okay, so here the third chapter of the financial reporting we completed. In next session, we starts with the chapter number 4. In chapter number 4, we are going to understand the reporting of assets, liabilities, and the disclosure in financial statements using the relevant Indian accounting standards. So, in which we are going to understand the Indian accounting standard 2, that is the inventories, Indian accounting standard 16, that is property, plant, and equipment, Indian accounting standard 23, borrowing cost, Indian accounting standard 36, that is the impairment of assets, Indian accounting standard 38, that is the intangible assets, Indian accounting standard 19, employee benefits. So, for all this purpose, that is for the employee benefits, that is we can say the intangible assets. So For all these, the different accounting standard provides the guidelines. So in next sessions, we are going to understand this part. Okay. Okay. If you don't have any questions now, then you can leave the sessions. Okay. Thank you, Mohit sir. You can now end the session.